Or hey, I was on the other one. I was on the other webinar and I wanted to know, hey, how can I get a copy of this presentation? Well, if you go to www.homebridgewholesale.com, if you want to get a copy of this presentation, you can go to Working With Us section and a copy will be there. And also a recorded version will also be posted shortly. If you want to see this video or the previous TRID webinar, you can go to the Google Plus page located at the bottom of the Homebridge Wholesale homepage, and you will be able to find it there. So at this time, I'd like to introduce Bill Schultz, who's General Counsel and Chief Compliance Officer at Homebridge Financial Services. Bill?
Thanks, Pam, and good morning, good afternoon to everybody. Wanted to, before we start into the first slide, just wanted to mention a couple things that are not on the slides. First, from a timing standpoint, we are at 53 days from August 1st, 53 calendar days and counting. For those folks who are in that category, 14% that are totally prepared, then you're, kind of relaxing probably, at this point. For the rest of us, we're going to be using up all of those 53 days to get ready and probably thereafter as well. I've used this for the last couple webinars. That's 4,579,200 seconds, 76,320 minutes, and 1,272 hours, depending on what time zone and how much you're working. So, it is coming quick. It is coming rapidly. And last week, the CFPB came out with a very soft statement about how there was going to be no grace period for implementation. There'll be no delay for the implementation. And at best, in the scope of examinations, the CFPB will be sensitive to the companies that have put forth a good faith effort towards compliance. What that actually means, we don't really know, but we know that while there was a tremendous amount of support in Congress and in the Senate to have stronger language about either delay or lax enforcement, the Bureau did not follow that request from Congress. So let's just jump right in. We're going to talk about the loan estimate first from an introductory standpoint. I'm going to read the bottom of this first. The goal of the integrated disclosures and loan estimate specifically was it to make it easier for the consumer to understand this transaction. So the LE, as a reminder, combines the initial TIL and the GFE and will become the standard forms for RESPA transactions, pointing out that HELOCs and reverse mortgages are not covered. There's a question whether or not co-ops are covered, and depending on how the state treats co-ops, whether or not they treat it as real property or not, that will more or less determine whether or not it's covered by the TRID rules. At the bottom, the design principles. The goal, once again, is easier text to read, more visually appealing. The more important and usable information appears first on the form, and you'll see that the LE and the CD should match. One of the things that's dramatically different from today to what we're dealing with in August is that if you put a GFE up next to a HUD-1 and try to correspond, you really can't do that in any usable way. There's a big difference with that as far as putting the LE and the CD together. These are dynamic forms. Inapplicable disclosures or sections that don't apply are not there. And also, if you're dealing with adjustable rate mortgages and so forth and they don't apply, those tables will not be there as well. So we're going to talk now about the timing requirements. Hopefully for most of you this is going to be a refresher as opposed to new material. So the initial loan estimate must be delivered within 3 general business days after receipt of the application. That application can be received by either a creditor, a lender, or a broker. If not provided in person, receipt of the LE is assumed within 3 business days after delivery or mailing. So at this point, we want to specify or distinguish the types of business days. For the purposes of providing the loan estimate, a general business day is a day in which the creditor's offices are open to the public for carrying out substantially all of its business functions. Simple way to remember that is that it's an open for business day, which means if you as the lender or the broker are responsible for issuing that LE and you are open for business, you have 3 days that you are open for business after receipt of the application to issue that loan estimate to your borrower. We're going to introduce the term specific business days now. 7 specific business days before consummation or the date the note is signed. This is when the LE must be delivered. This is the same as what we're dealing with today from the 2009 TILA changes with MDIA. If you remember the 373 idea, this is the 7, and the 7 doesn't change, which means is that no matter what, from the time you issue an LE, you will never close earlier than 7 specific business days after you've issued that. And a specific business day includes all days but Sunday and specific federal holidays. It's the same as what you're used to for the rescission rules when it comes to days that are being counted or not. It does not have to do with whether or not the company is actually open for business or not. Similar to what we are used to with the 2010 RESPA changes is that you have to issue revised loan estimate. Okay, so just like we started getting used to with the revised GFEs. Once we're made aware of the change, we have 3 general business days to revise and reissue that loan estimate. And once again, we're assuming for the purposes of this discussion that this is a valid change of circumstance. We'll discuss that a little bit later. Okay, when the rules started, there was some talk about whether or not rate locks would be treated any differently. But back in January, that was changed so that rate locks are treated as a kind of run-of-the-mill change of circumstance. The revised loan estimate must be delivered within 4 specific business days before consummation. And the reason for this is that once the CD has been issued, you cannot issue a revised LE. So you have to sequence so that you issue a revised loan estimate, and then thereafter you can issue your closing disclosure. Next slide, please. Starting at the beginning with application. Once again, we've covered this before, but it's important to reiterate this, is that the definition of an application has changed. It's 6 items. It's 6 items that all of us should be used to since the definition of an application changed in 2010. However, the 7th item, the lender chosen item, the catch-all item as it's sometimes referred to, has been removed, which means is that we have a universal definition of application across the entire lending industry. You have 6 items, you have to disclose the LE. 6 items in any form. It could be verbal, it could be on a napkin, it could be on a 1003. If you have those items, the loan estimate is required to be issued within the time frame, once again, within the 3 general business days. There is a note here that a creditor or broker may attempt to sequence the collection of information but cannot refuse to accept any of the 6 items. That has implications for web-based applications and other things where or you're doing a pre-approval or whatever, and you have 5 items, which doesn't trigger the LE, and you purposely do not want to have the 6th item because you don't think that the transaction at this point is legitimate and you do not want to issue the loan estimate. You can't refuse information if the borrower has it or if they're going to offer it. So once you have the 6 items, then that will trigger that LE disclosure requirement. Talk specifically here about wholesale and when a broker receives an application. Okay, once again, the broker's receipt of an application triggers the obligation to provide a loan estimate within the 3 general open for business days. Okay. There are very few references, in the rules, the commentary, and the various information from the CFPB about the broker's involvement, the mortgage broker's involvement in the transaction. Okay, but there is a specific references to the fact that the broker will continue to receive applications, but also can issue that LE. If the broker does in fact provide the loan estimate, the broker must comply with all the relevant requirements as if it were the creditor. There are no special rules for brokers. If a creditor is unknown, the broker would leave the loan ID number blank and the lender information blank. And the reason for that is that the loan ID travels throughout the entire transaction, from the point of the issuance of the LE all the way up through the CD and through closing. So if a broker issues a loan ID with their loan ID on it, meaning the broker's a loan ID on it, then that's going to cause a problem for the wholesale lender when they get that application and when they get that loan estimate and so forth. If the creditor accepts a loan after the loan estimate has been provided, the creditor is bound by the tolerance limitations. Okay? Similar tolerance ideas of what we're used to since the RESPA changes in 2010. We'll talk about that a little bit more, but once again, once the lender accepts it, then they are bound. Okay? Even if the broker provides an erroneous disclosure, the creditor is responsible and may not issue a revised disclosure correcting the error. The creditor is expected to maintain communication with the broker to ensure that the broker is acting in place of the creditor. It's a simple statement, but in practice, it is complicated, to figure out the nuances of how the broker is going to act in the place of the creditor in all the different circumstances that occur during the processing of the loan, the various changes that occur, up until the point in which that broker submits a file to the wholesale lender. And as mentioned before, there's not a lot of specific guidance from the CFPB on this, so as an industry in the wholesale channel, we are definitely still figuring these pieces out. Next slide, please. also discussing, what occurs up front, and with the 2010 RESPA changes, when the GFE changed, the industry, to a certain extent, started using what we would call the old GFE, the pre-2010 GFE, as a worksheet, a closing cost worksheet and so forth, because it was easier, frankly, to just delineate the fees and costs than the information that was on the GFE. So as we move into the August requirements, you can still issue, a worksheet, if you want to call it, a loan estimate, fee worksheet, and so forth. And a lot of people will probably use what they're using now. The important thing is that if you're using that format, there must be some specific language that's mentioned here, which says your actual rate, payment, and cost could be higher, get an official loan estimate before choosing a loan, and the form has to look visually different than the loan estimate. So you may not use headings, content, and format similar to the loan estimate or to the closing disclosure. And once again, if you're using something today, as long as you add in this additional disclaimer language and so forth, that should meet these requirements, but you just want to make sure. And once again, these requirements do not apply to either generic kind of pre-printed lists of costs. It's transaction specific where you have to follow these rules, and once again, general types of advertisements are not covered under these requirements. I'm going to talk now a little bit about the concept of good faith. It's a term that we've used, in the industry for years. There's some refinement to those requirements and to the definition when we're dealing with the August 1st changes. So the loan estimate figures must be made in good faith and consistent with the best information reasonably available to the creditor at the time of disclosure. And if the broker is issuing it, then they have to meet that same good faith requirement. And there's guidance on how do we determine good faith. We look at the difference between the estimated charges originally provided in the loan estimate and the actual charges paid by or imposed on the consumer. And generally speaking, if the charge paid by or imposed on the consumer exceeds the amount originally disclosed on the loan estimate, it is not in good faith. And there are exceptions below which we will talk about regarding tolerances and so forth. The bottom line here is that, the standards have definitely been raised as far as what the expectations are at the point that we issue this loan estimate. And some of the practices that people have been using for these years as far as, guesstimates and so forth, may be deemed as being no longer in good faith because of this, analysis that is done between the initial fee as disclosed and the actual final fee that's charged at closing. And once again, this concept of good faith applies whether the creditor later discovers a technical error, a miscalculation, or an underestimation of a charge. Next slide, please. So we talked about change of circumstance. We're going to get into it a little bit more detail now. And this is just to reiterate, the creditors are bound by the loan estimate and may not issue revisions because they later discover technical errors, miscalculations, or underestimations of charges. So there's no whoops, well, sorry, I really tried, but and so forth. So now I'm going to increase this or that. Just like we are used to from 2010. Okay, there are specific allowable circumstances when fees can change. Creditors may only charge more than the amount disclosed when the original estimate or lack thereof was based on the best information reasonably available at the time of disclosure. And I think that, once again, is a simple statement. Best information reasonably available at the time of disclosure. There's going to be a burden on brokers and creditors to have policies and procedures that support what was done for you to arrive at that best information. Whether it be using external sources for third-party fees, whether it be related to how you manage your vendors and approve vendors, and so forth. But definitely going to be enhanced requirements in that regard. Revised loan estimates are permitted in only certain specific circumstances. So we're used to the term change of circumstances. Okay, so we have a change that occurs after the loan estimate is provided to the consumer that cause settlement charges to increase more than permitted. We have FAQs that will be posted on that, which we'll talk about that, but it's very similar to what we're used to back in 2010 when HUD went out and gave a number of examples regarding change of circumstances. We have changed circumstances that occur after the loan estimate is provided to the consumer that affect the consumer's eligibility for the terms for which the consumer applied or the value of the security of the loan. Common example there would be if you have an LTV variance, your LTV goes up, and as a result, your mortgage insurance increases, and you need to, reissue because of that. That's a valid change, and so forth. Number 3 is a big one, which is the revisions are requested by the consumer. Even within this entire framework, we have not taken away the borrower's freedom of choice. They can still change their program. They can still change the structure of their program, whether it be their fee structure when it comes to their points, or if they're not paying points, whether they're doing lender or borrower paid, whether it be that they want to put more or less money down. We are not going to restrict the borrower here, but if we are reissuing based on a change, those changes in fees and terms and so forth can only be related to those specific requests from the borrower. Another common example is that we have an interest rate that was going from float to lock. That's common in what we're used to from 2010. And also another one from 2010, if the consumer indicates an intent to proceed with the transaction more than 10 business days after the loan estimate was originally provided. If you recall, the GFE today has a time certain under which your costs and settlement charges and so forth are good for. If the borrower doesn't express their intent to proceed during that window, the 10 days, then the fees can all be changed without any sort of problem as far as the lender or the broker is required. Also, we have changes of circumstance related specifically to new construction. So we'll move on to the next slide. So we're going to speak now about the form, specifically about the loan estimate. We'll start off with the basics, and then we're going to go into each section and get through into some of the details there. So once again, the goal of these disclosures is for it to be easier for a consumer to understand, and also for them to understand the most important pieces of their transaction first. So rates, payments, costs of closing are what you're going to see first. You also see that they've instituted some design principles that make it hopefully easier to understand. So in most cases on the loan estimate, you have whole dollar amounts. You don't have decimals. You also, other than the principal and interest, also for percentage values, you're only going to have up to 3 decimal points if they apply. You'll see that in the examples that we go further. And also, we don't have blank fields. So we never use NA or not applicable. If there's inapplicable sections, they're removed from the form directly. And if you have certain hard-coded fields on the LE where there's no value, they're just going to be blanks. There's not going to be NAs in those fields. Next page. This is page 1 of the loan estimate. We're going to take a minute here just to kind of look at the form, and then we're going to get into it section by section. I think the first thing when you look at it is that it doesn't look anything like a TIL. It looks a little bit like a GFE, but really it doesn't. And if you look at it, it should be easy for a consumer to pick out the most important parts of their transaction just from looking at page 1. And if that's the only thing they look at, they should see the basic terms. They won't see all their costs and fees, but they're going to see what's my loan amount, what's it going to cost me per month, what's my interest rate, and so forth. So once again, the design principles here, make it easy, transparent for the borrower to understand. So let's jump in, and we're going to look at the breakdown of each section, starting at the top, page 1 of the loan estimate, which is the general information. I'm not going to spend much time here. Just wanted to point out a couple things. First, as I mentioned before, you have the loan ID number there, which is once it's issued, it has to stick through the entire transaction. The other thing that I'm going to point out here is the term, not the loan term, but the use of the term product here, which has a specific connotation here in the context of TRID, because of the fact that, as you probably realize by now, if your product changes after your closing disclosure has been issued, then that will trigger a new 3-day waiting period. It's important that you have consistency and accuracy within your LOS as to the product type, okay, because it does have that downstream impact. The other thing you'll note here is the rate lock section. If you remember page 1 of your GFE, the important date section, it's been condensed really into this, and then you have your date issued on the left side, but this little paragraph here covers your 2 main things. A, whether your rate is locked, yes or no. If it is locked, when does it expire? And at what time and in what time zone, that's new. And then also how good the estimated costs are. So I talked about before about issuing that intent to proceed and so forth, and when your costs are good for. Once again, we also have an actual time and a time zone requirement there. We'll move on to the next slide. So the next section is the loan terms. Once again, most important information sticking right out in front for people. What's different about this is we have this dynamic column on the right side, okay, which tells the borrower up front, can these amounts increase after your closing? If you have no answers, then there's no additional explanation required. If you have a yes answer, then you have to your form has to say, to the borrower what's actually going to occur here. So this is an example of a prepayment. We don't offer prepayment penalties here, but is one of the ones that's commonly put out there from the Bureau. And you can see here that there is a description there that is a requirement. And if you have a yes indicator for any of these things, you'll see this type of dynamic language that must appear to help explain to the borrower, the more complex change that may occur with their particular loan type. We can move on from here. The next is the projected payments. This is the first time where you see something that actually resembles a till, in the payment stream that we're kind of used to. This section here, you have 2 columns represented here with your years, and then the change. In this example here, you have mortgage insurance that is there for years 1 through 7. Your MI drops off, and then you can see that years 8 through 30. In the MI column, we now just have a dash. And this can be up to 4 columns depending on the type of transaction you have. And your simplest transaction would be just one simple column for years 1 to 30. If you had a fixed rate, no changes, no MI, and so forth, you would see just 1 column. The next section, the estimated taxes, insurance, and assessments, is the first real introduction to escrows within these disclosures. And there is a consistent theme throughout the LE and the CD, consistent theme of putting a lot of information regarding escrows. I think the Bureau determined from their market study that escrows cause problems for people. They don't understand it too well. It causes problems post-closing when loans are in servicing. And hopefully this additional explanation will eliminate some of those concerns and misunderstandings that borrowers have. But it's simple. You have whether or not you're, in this particular case, your taxes and your insurance are in your escrow. It's a simple yes, no. There should not be a question about that stuff. And then also you'll see here that you have rounding. The next is the cost at closing. It's okay. We're good to the next slide. And the cost of closing, sorry about that with the phone there, the summaries. So similar to what we're used to seeing at the on the bottom of your GFE, but what you're going to see here is more description. Okay, so you're going to see that within your estimated closing costs, the top example is a purchase, the lower one is a refinance, is that you can see that there's a description there that tells you what are the components of my closing costs. And then it also directs the borrower to page 2, and we'll get to that, where you can see the breakdown in the more details. So you have your closing costs and your estimated cash to close. And then in the lower section, we have an example where we have a cash out refinance where there's cash coming to the borrower. So we can go to the next slide. This is page 2. This is where we'll see something that resembles page 2 of the GFE. Once again, not exactly, but there's some resemblance there. You'll notice here that the design is different, the layout is different, the groupings are different. But at the end of the day, this is where the fees and costs are going to be detailed. Wanted to point out a couple of design principles that go along with this. First is that we have uniform alphabetical fee naming, which is new. Okay, and that's a requirement. Within each section, you will see the fees are listed in alphabetical order. The fee lines, there's no numbers. Okay, now we have these sections, and we have the alphabetical listing of the sections. We have the number of lines allowed are being defined, which means that you can't, within certain sections, there are finite lines, or once again, you'll have blanks if they're not going to be applicable. The dollar amounts are rounded. You can see here there's no decimals, not a single decimal in this entire page. And also critical in TPO business is that the lender paid compensation is not disclosed. Okay, it does not appear anywhere on the loan estimate. Borrower paid compensation would appear. Lender paid does not. This is one of those areas that is definitely a win for the broker community. And once again, from the Bureau's perspective, the borrower is not paying this as a fee, and therefore it does not need to be reflected here. So that's good news within the context of the disclosure requirements. So let's go to the next page, and we're going to drill down just a little bit on this. And I'm going to pick up the page just so we can get through here from a time standpoint. So I wanted to just mention here that we're used to seeing how the origination charges have to be itemized out, pointing out here that the first item, the percentage of loan amount, is the only place that you can list points per se. It's the only place where you can list a percentage of the loan amount. It does not have to be points for the purposes of QM or other definitions, but it has to be a point that does in fact reduce the actual payment, the interest rate and obviously the payment. You'll also notice here that this is where we have the other origination types of fees, application, underwriting, and so forth. This is important. We mentioned before about uniformity. If it's called an application fee on the loan estimate, it has to be called an application fee on the CD. You can't abbreviate, you can't change it. Okay, that's going to cause some challenges for the wholesale universe as well because of the differences in the types of fees that various wholesalers charge. In the services you cannot shop for, this is a new way of designating these types of fees, and you can see the various types of fees here and how they're broken out, and then you also have the services that you can shop for. Wanted to point out here that specifically in the title section, anything that has to do with title starts with the word title, then you have hyphen, then you have the actual description of that fee in alphabetical order. That is different than what we are used to today. It's not the way title bills necessarily come in today for most folks. So that's going to be another area where it's going to take some training and some work there. We also mentioned here the tolerances that go along with them, and we'll get into that a little bit more as well. Moving on to the next section, we have our other costs, recording and other taxes and transfers. We're used to having those specifically designated as they are today. Recording fees remain in the 10% tolerance, and transfer taxes remain in the 0 tolerance. Okay. You can't add any more lines here, so whatever has to be covered within your recording and other taxes can only be put into these 2 lines. The prepaids in initial escrows and so forth are similar to what we're used to today, so I'm not going to spend much time on them. Wanted to mention here other. Now, this is the other section, and the other transaction-related costs will be put here. Owner's title policy has specifically found a home here. Once again, not a lender required, not a lender requirement, so it is put in the other section. We can move on to the next slide, please. So we mentioned a little bit about calculating cash to close on page 1. Page 1 points the borrower to page 2 for the detail here. I'm not going to spend a ton of time here, but wanted to point out a couple of important aspects here. First is on a purchase, the calculating cash to close looks similar or if not identical to your 1003 details of a transaction. So you think about that now, the GFE does not reference your earnest money. It doesn't, make account for any deposit that was given, and then also you have here where you have your seller credits. And if you look above that to the right where the J total cost, closing cost section is, you have your lender credit section as well. Wanted to point out here that lender credits are a 0 tolerance item, which means that your lender credit cannot decrease after it's been disclosed. Okay, you can give more of a credit, but you can't decrease it. Simpler speaking, for a refinance, you'll see the alternative version of this. And there, once again, cash to or cash from, depending on the type of refinance transaction that you're dealing with. We can move to page 3. So this is new. We have lender and broker information appearing on the same form. Neither the TIL or the GFE has that. And it's not just the basic information. We also have license identifications for both state and NMLS, for the company and for the individual MLO. Okay, so that information is now going to be disclosed, and it's going to carry through the entire transaction. We have comparisons. For the first time here, you see the APR. So we've gone from truth in lending, front and center on the TIL, to page 3, kind of stuck in the back. So APR determined to be of less importance to the borrower's understanding of the transaction. But we still, as lenders and brokers, still have to deal with APR. We still have to do the designations for what are finance charge fees. We still have to, we also still have to do rate spread tests and other tests that are based on the APR and the rate spread at the state level and also for the agencies and so forth. So while it's diminished and while nowhere on this entire document does it indicate whether or not a fee is included in the finance charge, we still have to do the calculation. As we've mentioned in prior webinars, we have also the introduction of the new factor here, which is called the TIP, the total interest percentage. And this is the total amount of interest that you will pay over the loan term as a percentage of your loan amount. We expect that the TIP will replace the APR as the part of the disclosure that causes the most challenges when it comes to having to explain this to the borrower. But we'll deal with that on future webinars. Wanted to mention here the additional disclosures that come here. We consolidate some things. So we have the appraisal disclosure that we had to introduce for ECOA delivery purposes that now we can combine here. The servicing disclosure, which is a standalone, now can be combined here. And the other disclosures there in the middle are all things that are coming from your existing TIL. Last but not least, we have a confirmation of receipt. Wanted to point out here that this confirmation of receipt does not replace the requirement for an intent to proceed. As we got used to in 2010, the borrower has to separately indicate an intent to proceed. Most lenders require that to be done in writing. We will continue to require that to be done in writing, and it will be a standalone form, just like we're used to today. So while we have this signature block, it doesn't replace the need for the intent to proceed. The last topic that I want to discuss today is the, once again, reintroduce the concept of tolerances. This will be on the next slide. And we'll finish out here with, once again, we're used to the term tolerance. They also introduced the term variances here. We're used to the regime. It's the same regime. We have 0 tolerance items, 10% cumulative tolerance items, and no tolerance. Okay. The one thing that we wanted to point out here is that we have a new addition to the 0 tolerance item, which are fees paid to an unaffiliated third party if the creditor did not permit the consumer to shop. So that's section B on the LE page 2. The items like your appraisal, like your credit report, like your life loan flood cert, and so forth. Those are now 0 tolerance items. Also, they've unified the entire universe when it comes to affiliated parties. So when you have an affiliate, whether it be of the creditor or the broker, if you have a fee paid to any of them, the creditor, the broker, or an affiliate of either for anything, it is in the 0 tolerance bucket. The rest of 10% and no tolerance are used to what we're seeing today, so we're not going to spend more time on that so we can get to the FAQs. So I think, Pam, you're going to close us out here and then we'll get into the Q&A portion.
Yeah, actually, we are going to start. We are getting quite a few questions in our webinar panel in the question box. I'm going to start with a question for you, Phil. Does email submission of the loan estimate meet the 3-day requirement of notification?
Okay, so I'm going to, this is a complicated question, so I'm going to answer it, as simply as I can just because of the benefit of time. Electronic delivery isn't an acceptable way for delivering the LE, just like the other disclosures are today. You have to meet with the e-Sign Act requirements just like you have to today, which means there's a requirement for consent. You have to be able to track it. Okay, you have to be able to track receipt to the borrower. So if your email system is a secure system, if you meet the e-Sign Act requirements, if you can track it, being that you can track that it was received by the borrower, then it's acceptable. But I think you have to look at your technology and your actual process to make sure that it meets those requirements, because those requirements about e-sign and e-delivery exist separate and apart from TRID, and basically TRID says that if you're following those requirements, then we're going to allow these disclosures to be delivered to the consumer.
Great, thank you. What changes trigger a redisclosure 3-day waiting period? And does the redisclosure have to be within tolerance, or is it just when you're out of tolerance?
Okay, I think the context for this question is the closing disclosure, I think. So let me answer it that way, because when we think about the 3-day waiting period, we're thinking about it in the context of the closing disclosure. As mentioned before with the loan estimate, if we have a change of circumstance, we have to reissue within 3 days. This, I think, is a different question, which is that once the initial closing disclosure, has been issued to the borrower, there are 3 specific events that will trigger a new 3-day waiting period. I wanted to mention that last week the CFPB came out with a posting on that, a 1-page fact sheet about that, and I think the reason that was done is because there was a lot of confusion, a lot of misinformation about what triggers the 3 days new requirement for CD. So there's 3 specific ones. Let's start with the easy ones. Prepayment penalty. If you add one at the very end after you've issued your CD, that's going to trigger. The other one that I mentioned was a product change. So if you're in a 5-1 arm, you issue your CD, and then for some reason you're going to change to a 1-year arm, you're going to require reissue of that CD in a 3-day waiting period. The third and most common one is if you have an APR variance. Okay, so a lot of press on the APR. Basically, it's an 1/8 for regular transactions. Regular transactions are fixed rate mortgages, and most ARMs fall into the category of a regular transaction. So if your APR increases by an 1/8, it's going to trigger a new 3 days. The other category you have there is for irregular transactions, which are uncommon, at least in our world. Things like graduated payments and other types of more complex type structures. That's a quarter variance. If that increases by a quarter, then you would be required to reissue within 3 days.
Okay, thank you. If the loan estimate is created by a lender, will the lender also issue all the upfront disclosures so the broker doesn't have to do that anymore?
I think it depends on the lender, and the reason I say that is because TRID doesn't introduce any new requirements when it comes to all of the rest of the disclosures. So the other federal disclosures, whether it be the ECOA disclosure, whether it be your GLB privacy notice, and all of your various state-specific disclosures, the TRID requirements don't impact any of those. So I think it's going to be a lender-by-lender decision. I think what you're going to see is that the loan estimate issuance is going to be treated as a unique event. For the one practical reason is that 6 items triggers the LE. Meanwhile, you may not have sufficient information to issue any of your other disclosures at that point. So I think we're going to have to wait and see over the next, obviously, 53 days how everybody's going to be responding to that in the wholesale community.
Great, thank you. So are broker fees disclosed, and does lender paid comp show on the loan estimate?
Okay, that was answered on one of the slides. On the loan estimate, lender paid comp is not disclosed. It is disclosed on the CD. We'll have a future webinar on CD and we'll introduce that. Other broker fees, whether it be, as mentioned before, points in the origination section, block A there on page 2 of your loan estimate, broker fees, so forth, that stuff is all going to be listed as it is today as a charge. It's paid by the consumer. It's going to be listed there as a charge and in the origination section.
Thank you. Question on zero tolerances. Can fees be overestimated in order to avoid tolerance cures or redisclosure?
It's a difficult question to answer, in a vacuum. I think the general way to look at this is that we have this concept of good faith. And I think that, if you look at the language there, reasonable efforts and so forth, I think a pattern of, always redisclosing, not based on anything that's specific, I think may cause some questions about whether or not you're doing it in good faith. If you're using, a valid source for estimating your fees, meaning your lender fees, if you're doing the same thing when it comes to, your third-party fees, your title charges and so forth, and if you end up being slightly over, that may not be an issue. But it's kind of mushy, I got to be honest with you, because that term good faith and reasonable standards, it's going to be hard until you start seeing people, I hate to say it, getting either examined or enforced on it.
Okay. Another question regarding zero tolerance on appraisal fees. What happens if the appraisal bills for fee plus mileage or reinspection? Would this constitute a change of circumstance?
I think it depends on who you ask. I know that some folks have been asked to comment on that, and they think that these are the types of things that should be accounted for in advance, that the lender and the broker and so forth should have a pretty good idea on what these are going to cost, and the AMC that you're working with should have a good idea, and the price structure shouldn't affect the consumer if somebody's off with those things. So I think it's one of those areas where, there's been no reissued FAQs about change of circumstance since 2010, April 2010 when HUN came out with it. So there's no new FAQs that go along with this initiative from the CFPB on this. So I think it's one of those things we're going to have to wait and see. I'm not really sure how lender to lender is going to treat this one.
Okay, thank you. Can lender credits change from the initial loan estimate if the interest rate changes and the lock is if the loan is not locked?
The answer is yes. In fact, this is one of the examples that was issued on here. And once again, that's an area that follows from 2010, which is that going from a float to lock is one of those areas where you can where the pricing structure of the loan can be modified as a result of market conditions and so forth. So the answer to that is yes.
Thank you. Should several title companies be listed on the settlement provider list so it would fall into the 10% bucket?
I mean, I think that, once again, this is one of those areas where people are going to have to get into their own operational mechanics for how to handle it. And I say that because there's definitely increased burdens on the requirements on the service provider list. There's more information that you're required to disclose, and you also are required to give, geographic vendors. So you have to be able to give people that are either national that can provide the services or people that within the region that can provide the service. So I think that for some people, they want to be in a situation where the borrower is going to go out on their own, so it doesn't go into the tolerance category. And I think that for others, they want to at least be in a situation that that it's at most 10%. So I think it's going to be kind of an individual company's decision on how to deal with that one.
Great, thank you. And and thank you again, everyone, for asking all your questions. We are limited on time, so just in the last minute or so, Phil, can you discuss the impact of last week's announcement by the CFPB?
Okay, so obviously I mentioned it when we started this program, about the whole idea about sensitivity, during the examination process. I think it makes it very difficult for lenders. I think that, especially the last 30 days, a lot of the industry has really gotten into this and realized how vast these changes are, and there is a significant dependence on technology for all of us, whether it be your LOS provider, whether it be your portals, the people that deal with integrations, your doc providers, your compliance providers. They're all impacted by this. I personally, from everybody that I talk to, have not heard of any vendor that says today, we are ready to go. Bam, we are good to go. Most companies are still, tweaking their final versions. They're still needing to then get that out to their customers, meaning the vendors, to get it out to people like us so that we can do more extensive training and testing, and then along the way, take the workflow kind of setups that we've come up with and see how how the vendors and the LOS and so forth operate within those contexts. So I think this exercise for the last 6 months has been theoretical for a lot of folks, us included, and now is when we're going to actually have to see how it's going to work out. So I think it would have been nice for the industry, if we had gotten a formal breathing period. If we remember back in 2010 with the RESPA changes went into effect, there was a 4-month transition period that was published by HUD, to give the entire industry. And I think TRID reaches a lot deeper, and I think that we would have benefited from it, but we're all in this together, so I guess we're all going to be dealing with the same challenges for the next 60 days and so forth. So that's it.
Great. Thank you so much, Phil.
You're welcome.
And as everyone can see on your slide in front of you, we are offering our third part in our webinar series on July 9th. And our guest speaker is going to be Benjamin K. Olson, who is with Buckley Sandler, a partner in Washington, D.C. office law firm. He also had been with the CFPB, so this is one you don't want to miss. So it's been great having everyone with us today, and I applaud you for taking time from your busy schedule to learn more about this TRID rule and its industry changing, so we all look forward to all more learning experiences. As a reminder, you can go to www.homebridgewholesale.com to receive a copy of this presentation and also to view the previous presentation and also listen to the recorded version. Thank you again for joining today, and have a great day. Thank you. Bye-bye, everyone.